bright future. We're talking real money.
We build programs based on you. We want to give you answers to your questions. That's why we take your questions at talkingrealmoney.com on the contact us little button there. But we more than that, sometimes we will base an entire show topic on some of your queries because they're good they're good ideas for programs. And one of the things that we touch on a regular basis, but really don't dive deeply into, is the concept of proper portfolio population
Oh,
or
I was going to say
diversification.
design, but you had
Yeah,
to stick
no,
with the
I had
P's
to
there.
I had to go
Way to go.
alliterative on that.
That's when you're great,
Uh,
you do that kind of thing. So
yeah,
well done,
well,
sir.
you
There you
know,
go.
how you build the right portfolio uh, in its composite parts, not as much based on you. This is the basics of the basic building blocks of the portfolio that you then manipulate based on the you part of the equation. This is the basic blocks that go into a portfolio. Now, these basic blocks are subject to all manner of variation depending on who you're talking to and who you're working with. The most basic of basics is just basically stocks and bonds. Stocks and bonds. Diversified stock portfolio, diversified bond portfolio. That's about as simple as it gets. But there are people out there that we respect who take it a little bit further.
Yeah, there are. And, one of the three questions they use for financial literacy is it safer to own an individual stock or to be diversified in a mutual fund?
Oh, come on.
Well, now I'm hoping
Is that a serious question?
that's one
I
of the
mean,
three.
really?
And the three people, I think I read, it's about 25% of our population that can answer those three. It's a very small
Okay,
number.
but that one seems like one
I
everybody
don't know,
should
though.
know.
Well, yeah, but if I bought
One
GE
stock
in
safer than buying
1920,
all of
it's
the
been good.
stocks?
I know. Well, that's anyway. So that is one of the
Boy,
questions,
we are a bunch of dumb
and
bunnies
let's
then, aren't
just
we?
go ahead and give the answer. The being diversified is better, just so we can.
I didn't
It's
even
safer.
feel the need to give that
I'm going to
answer.
give that answer. So, but this question comes from
My expectations are higher than yours.
Jefferson and this is a place I should probably visit, Thomasville, Georgia. I should probably go there. I think, would I be popular there maybe? Or
No,
did they
not any
give me
more
a free
they
something?
no,
No? Okay.
no.
I guess not. So I was very excited. Thank you for writing us, Jefferson. He says, what are your thoughts on Paul Merriman's? And just again, for full disclosure, Don and I worked with Paul Merriman for many years. I was a partner with Paul Merriman for many years. We continue to admire his work. He speaks at Retire Meet regularly, but he wants to know our thoughts on Paul Merriman's 4-fund portfolio, which divides your stock portion of the portfolio into 4 areas. Number 1, 25% in large cap blend, 25% in large cap value, 25% in small cap blend, and 25% in small cap value. So I thought it might be worthwhile to go through that.
Wait a minute. Now let's do that. I don't hear any international in there.
Well, no, he didn't get into the U.S. versus international. This, I think, what the take would be is this is to say you do this overseas the same as you do it here in the United States.
All right.
We already decided we will gently again debate the U.S. versus international part. We tried by text last night.
By the way,
I
found a better place for you to go other than
internationally.
Thomasville. Yeah, you should go to Cockeysville, Maryland.
Cockeysville, Maryland. Actually, I'm going to be back there in a few weeks, so maybe I will.
Yeah, there you go.
Add that to the
Cockeysville, Maryland. It's in Baltimore County. It's 20 miles north of downtown Baltimore.
Cockeysville,
Maryland.
Things you never know, and you probably don't need to know.
It's a thriving suburb.
I love it. Okay, so but let's go back. Let's talk about the things that I think you should own. Then we can talk about the percentages, and we can talk about Paul's, because I think you need to own. He mentions large cap blend. Well, the S&P 500
is that.
I mean, it's pretty growthy now just because of the weight. I mean, the PE ratio is like 22 or something, but but I think that probably is the S&P 500. Here's where it gets trickier. Owning 25% in large cap value. That's harder to do. I would have to go through the funds of which to find. There's probably a Vanguard index fund that could do that. But anyway, yes, that would be a good way to break up the U.S. portion between the large side of it. And then do we believe that you should have 25% in small cap blend? Here's the argument I would have. Small cap blend has greatly underperformed small cap value. I might want to have 30% in small cap value and only 20% in small cap blend. Now, as soon as I say that, Paul's listening and he's going to write me and go, we back tested this to the year, 001, and it works better to balance it out. So that's all well and fine. So I think you should own the S&P 500. You should own U.S. small cap value. You should own, yes, U.S. small cap blend. I would just call it U.S. small cap. You should make sure that you own U.S. small cap value. You should own REITs in a small amount. And here's the other part that that gets overlooked, and we're going to discuss it, I think, at least somewhat. The same things overseas, right? I mean, you got to have those big companies. They dominate the economy. You got to have the smaller companies. You got to have the value firms. And then as part of international, the other thing I see people overlooking, even though, again, I looked it up, it's been the best performing markets since 1990. You need to have emerging markets in there. You got to own Brazil and India and China and some of those other countries that are developing. That should be in your portfolio as well. And this is from Paul's website now. I went and looked today at what the return of that portfolio has been. The four divided between, in his case, 50% U.S., 50% international, rebalanced annually.
Wait a minute. In his case, he said 50% U.S., 50% international.
That's
really?
right.
Did he say that?
He did. He said,
did Paul
because
say that?
Don said that, I'm going to go with it. That's what he said.
Oh, he did not.
No, he will, though. Don't worry.
No, he won't.
That portfolio, wow, going back to 1970, which is a long time ago, has returned 12.1% a year with a standard deviation of 18.3. So you've had to deal with some ups and downs, right? Because that's, certainly a higher standard deviation than you would get, more volatility in the S&P 500.
What was the standard deviation?
18.3.
That is high. Yeah.
It's high. So you have to deal with the ups and downs, but the return has been pretty good. So here's where there's you mentioned this, that we could bring in 100 experts into this small studio that I'm in today.
We can't fit them all in.
I know, and they'd have to be small. But we probably get 100 different answers when you boil each asset class down. Where I've done the research and the market's changed in the last 30 years. I got to do it this way, or blah blah blah. So I went and looked because I was curious. Because Don and I did have this text debate about the U.S. versus international last night. Now, those of you who know,
by the way, I sent an email to Apollo. I wanted his answer, so I'm waiting.
Well, his answer I'm going to give you.
Because, you got it from him?
No, I got it from the actual practice of dimensional funds. Dimensional funds.
They have a lot less in international.
Well, they have a one fund solution, as you know, that is DFAW.
Yeah, I'm just looking at it right now.
73% U.S. and 27% international.
I basically asked him if that was pandering.
That's a good question. AVGE, which is the Avantis version of a very similar fund, is 71% U.S., 28% international. Now, when we manage money for people, we are, I just asked today, 66% U.S. I believe that makes us 34% international or so, because we keep a tiny bit in cash. I also went back and looked at the return relative to those funds. DFAW in 2024, this is a very short track record.
Yeah, very short track record.
15.5% return. AVGE last year, 2024, up 13.9. Now, my portfolio is managed to that 65-35. Don's is managed to 50-50. But I guess gave you two other examples.
It's not. It's like more. I looked. It's closer to 60-40. I need to.
So
yeah.
But and we could get into all the debate. We did this last night by text. You can do it again if you want. But the point is, you should own all those assets. All those things should be in the portfolio. You may.
And I didn't realize how much more I like Paul's portfolio than I do all the others now.
It's simple. It's easy.
Well, and it's 50-50.
To buy. Yeah. Now, what would you buy for the U.S. large cap value is, I guess, one question. What fund would you
based on what he's doing, I would probably go with Vanguard.
Because they probably have a pretty inexpensive
exactly. And the fact is, see, you're doing your own tilts. So you're instead of relying on Avantis or Dimensional to do your tilts for you,
You got to build it yourself.
You got to do it yourself. Now, does Vanguard have a large cap value?
I would think they did. And here's the challenge I see with most people, because many of you come to us and say, look, I'm really smart about asset allocation. I know what I'm doing. I've been listening to your show for years. I'm listening to Paul, etc. Here's my portfolio. What do you think? Most of you have 70 to 80% in the first asset class, the large cap blend, because it's the Standard & Poor's 500. You do not have enough apportioned to value, both large and small. You don't have enough small. You don't have enough international. Most of you are missing emerging markets. You're missing the other parts of the market that have done two things. The diversifier has at times reduced the volatility, and at times those other parts have greatly outproduced the United States. We've discussed this ad nauseum on this podcast. So you really got to make sure you own those. And as I said, they're harder to buy, correct?
Yeah, as a matter of fact, I'm really struggling to find a index large cap value fund. I'm not finding it at
Morningstar?
no, not Vanguard. Not Vanguard.
I'm trying to think of the dimensional funds equivalent with an ETF, because you can't buy their mutual funds unless you're using an advisor, of course, but you could use their exchange traded funds if they
that's a
had
good one. That's a good one.
U.S.
That's
large
probably
cap
where I
value.
should go.
And I'm sure Avantis probably has one too.
Let's see, large cap value. So we're going to have to go there for the large cap value ETF. And let's see who that would be. Okay. Yeah, dimensional, it's DFLV.
So you could use that for your
large value, and
DFLV.
and then they have a small value, and they do have
of course,
a large blend. And
you're talking, which is going to be, it's going to tilt still to smaller and more value companies.
Right, it's
going to
still have a tilt.
Yep, correct.
Yep. But it's a blend. See, that's the thing. Yeah. Okay, yeah, you could do that with DFA or Avantis. It looks like a whole lot more easily than you could.
You could find the asset classes. Correct.
With Vanguard. So that's where I find those
so there's two parts to the difficulty of doing all this. Number one is building the portfolio correctly. You have to decide between a number of different people about this, not just the stock to bond ratio, because that's personal, the U.S. to international ratio, the large to small ratio, all those things. You got to build it, right? That's part one. Number two is you got to do that thing that's even more difficult, especially in times of market turmoil, and that is rebalance the portfolio. You got to take from
There's
the things
the
that tricky
part.
It really is.
This is where buying a fund and sacrificing the global exposure that I'd like to see you have may make more sense, because at least it's forced, automatic. They do it for you, rebalancing.
That's
when you buy a fund of funds.
Right. Makes a lot of sense from many people, especially if you're not trying to do things from a tax standpoint, or if you don't have a lot of different accounts. Just to keep it simple with the one fund, I think it does make sense. It's there. So yes, the short answer, Jefferson, is, and thank you for living in Thomasville. I'll be by to collect my key as the mayor here sometime soon. I'm an admirer of this portfolio. Paul's website, paulmerriman.com, they update all these tables and all the numbers. And we just had Chris Pedersen speak at Retire Meet. He went through all this stuff. They spend legion hours on seeing what works over the long haul, and he's done great research with that. So great question.
Yeah, and by the way, the DFA International Value Large Cap Value Fund is DFIV.
DFIV. Okay, I've heard of that one. So, all right, are we going to move on? Because I've got other questions.
Moving
here.
on. No questions. Good.
Yes,
I like them.
A lot of questions. This comes from George in Massachusetts. He said he retired in 2001 at age 34. What are you, writing to brag or something? But I mean, that's good for you. It said he had $2.7 million in liquid assets. It's grown 10 times with very simple. So is that like $30 million? Sounds like it, right? 10 times on 2.7. Wow. Up over 700 with stock market mutual funds, ETFs, and a few well-chosen tech funds, pardon me. I frequently hear you warn possible early retirees about their Social Security estimate being based on their continuing to work and discouraging them. But I wanted to share my experience. In 2003, my SSA statement said I'd receive $1,402 at age 70. By the way, if you have $30 million, it don't matter what you got coming from
Yeah,
Social
who
Security,
cares
but
about
then
Social Security?
whole going to matter. I didn't work at all until 2010, at which point my SSA statement said I'd receive $1,707 at age 70, reflecting the 22% COLA over those years. So my Social Security wasn't negatively impacted by retiring early, and the calculation didn't assume future earnings. Your recent podcast about several people who wanted to retire early seemed overly pessimistic about possible stock market crashes. In reality, over 96 years, 94% of the 10-year periods have been positive ones. Yeah, over the long haul, the market has gone up.
Oh, you see, we're not concerned about them from a financial long-term
No, not at all.
standpoint at all. We're concerned about them from a psychological standpoint.
Totally, because
That's
we've seen
all.
people give up. We saw people wasn't that
And
long ago.
and
COVID,
and
people gave up. 2008, they gave up. 2000, so it happens.
and I would be shocked if you were sitting in the audience at Retire Meet with $30 million and I said, "Okay, now here's the deal. Today you have your portfolio, tomorrow you only have half of it.
Yeah, and most
And
people would
you
not be
don't
happy.
know when it's gonna come back, if it's gonna come back. Right
It
now,
always
you don't even
has.
feel like it's going to come back, even though it always has. It
Yep.
feels different this time, so it feels like it's never gonna come back. So you just lost $15 million. What do you do?
But let's go back to his question, because it's about warning people about Social Security. Now, this is kind of he worked for a while, he didn't work, et cetera, and his estimate went up, et cetera, et cetera. Okay, yes, you do get the COLA, but Social Security looks at your top 35 earning years, 35. So you can do it any way you like. It will continue to go up, yes, but you're getting zeros all those years that you're not working, right? I mean, that's a
Right, so
zero,
you're
zero, zero.
still gonna get Social Security based
Correct.
on the fact that you worked before.
You get
It's
the
just
10
you're not
years.
gonna get as much as
Right.
if you'd worked over 35 years.
Yeah, it's going to give you zeros there.
That's all we're saying, yeah.
And it does. You're right. The calculation, he says, does not assume future earnings. It just looks at the top 35. I think I had made the presumption that if you continue to work, that would be among the top 35 earning years. You're right. That
Okay,
could be
yeah, they're
different.
not
That's
they're not
fair.
projecting forward.
Correct. They're just saying
But
this is what you're making. Made.
my highest earning years personally, and this is the case, by the way, it's not just anecdotal, the numbers bear this out. Most people's highest earning years are in the final years before they collect Social Security.
Yeah. Which how long till you're going to be drawing next year, right?
20, let's see, 20.
You can do the math.
26.
Yeah, that's coming up. I mean,
26. Summer of
wow.
26, I start taking Social
You
Security.
excited?
Well, it's a big fat check.
I know.
I mean, it's a big check.
I
I'm
know.
shocked at how big it is. It's almost $5,000.
I know. Then that's a lot of money.
And with my lifestyle, 5,000's a lot of money.
That's a lot of Chick-fil-A chicks.
Yeah.
Chick-fil-A. What are they?
I don't pick up chicks at Chick-fil-A. I like the nuggets. I prefer the nuggets to
over
the
sandwich.
fingers. Yeah.
All right, let's try and squeeze in a couple more questions here. All right. Thank you, by the way, George, and congratulations on the $30 million. I hope you remain to be friends, because we like people with $30 million. Dan writes us from San Francisco. Says, I have $2.5 million portfolio split between an IRA and a taxable account. There is $500,000 and change in the STAR fund, which is in the taxable account. The rest is in VBR and VTI. It is 60/40 in Vanguard fund of funds. The cost per share, $25.40. Total cost, $457,000. Short-term gains, $3,200. Long-term gains, $50,000. All right, keep that. We're at about $500,000. Long-term gains of about $50,000. Would it make sense to sell the fund and buy a more tax-advantaged fund such as AVGE? I don't need the money for 10 years. I have a bond fund in my IRA and use that to rebalance. In other words, at what point do you say, look, I've been in the STAR fund. I don't expect, and it had good performance for a while, but I don't think it's been great lately. I could be wrong about that, but it is actively managed. It's more expensive.
It's doing fine. Its
Okay.
average annual return's been like 12%.
Yeah. At which point do you say, I'm giving up on
Let me look
STAR,
here.
I'm going to pay the tax and move
No, I
it into
take that
something more
back. I take that back.
tax
It's
efficient?
9%. I was looking
Okay.
at the wrong thing.
Yeah.
So it's 9% since inception back in 85.
Been around for a while. Yeah, 85.
7.7 for the last decade. But it is wow, it is.
What's the expense ratio?
Actually, it's like 40/60. It's the other way, I think. Let's see.
Is it
Short-term.
40-60, the Star Fund?
Let's see. We got investment grade, Ginnie Mae. That's 25. 2031. No, it's 60-40. Yeah, it's
Okay.
60-40.
But, okay.
Fees are.
How
looking
much?
them up. Hold on. 0.3.
Not horrible.
Not horrible.
But
it's an active.
It's actively managed.
Well, it's a fund of funds.
It's a fund of funds.
So it's got
What would I
actively
do?
managed funds in the fund.
I would probably design a strategy to sell out of it over time.
Yep.
Because you don't
Based on tax bracketing.
Correct. Yep. So probably come up with that strategy, because it wouldn't be a fund that we would own. If we woke up tomorrow, we would not.
Nope.
All right, real quick. Angela writes us from Mount Airy, North Carolina. I'm considering making
That is, by the way, what is Mount Airy's claim to fame? Do you know?
The wind blows a lot, Mount Airy?
Nope.
A guess?
Nope. It is the town that was the model. It was Andy Griffith's hometown.
Oh,
it was the model for Mayberry.
Yeah, looked like a pretty comfortable, friendly place.
I mean, think about it. You know, they from Mayberry, they'd go to Raleigh. Just
that
down
was the big
road.
time.
The big time. They go to the big city. They go to Raleigh.
Okay. Well,
Mount Pilot, and there's a Pilot Mountain.
Okay. I'm glad we're able to share this trivia that is not meaningful. Angela says,
hey, it's something different.
I'm considering making IRA contributions into 3 small Roth accounts in addition to my main Roth account. In other words, 3 accounts for 3 young children in my family. I'm 55 and would be able to make withdrawals for any reason by the time they're old enough to need the money. I'd like to keep the money in my Roth in case I end up needing it for myself. I don't anticipate that. In other words, putting money in a Roth and then leaving it there for others to spend. Is that a good idea? Because basically you can take out the contributions after 5 years with no tax. You can't take out the growth. Obviously, you're going to pay tax on that. So my short answer is I don't like Roth sort of for long-term savings, because I think these should be sacrosanct.
Well,
right?
it's a waste of this wonderful vehicle.
Right. So probably I wouldn't recommend it. If you're going to save money for somebody's future and they're going to use it prior to retirement, then I'd probably just do a regular old brokerage account, depending on how old they were, maybe a custodial account of some kind.
Yeah, because when they're young, they don't
Correct.
have much income anyway.
Yeah.
So their tax brackets could be non-existent to low.
Yeah. But if it was an emergency, you could get the money out anyway, right? I mean, if you had to have it, if there was a medical emergency or something came up in their life, I really try to reinforce with my kids and grandkids that the money that I put in there never should be touched. And I mean, in my lifetime.
With your grandkids?
Yes, I've told them that, sure.
You have had money talks with those 2 hyperactive boys?
Yeah.
Sure you have.
Of course I have. You know that.
Yeah.
Right
and
before we jump in the lake.
When Grandpa gives you $1, don't go buy candy with it. Oh, yeah, we're buying candy.
I give them the candy. They don't need to buy that anyway. I got the big bag of that waiting for them right before I take them back to their moms.
Kids don't go to the store anymore.
No, they wouldn't know how to do that.
They know how to shop on Amazon, but they don't go to the store.
And by the way, to get to the store from my house requires more than a small bike ride. So it's a long haul, as you know.
Good point. There's no Mayberry in your place.
No, nothing whatsoever. So
I'm
not a fan
you're
of this.
You're kind of out with Andy and Opie by the lake out in the woods.
Way out in the lake. But they caught fish at their lake. So it's good. So no, I wouldn't be in favor of this, Angela, is the short answer.
Me too.
Is that a good answer?
I go along.
It's the only one I got. So sorry.
Are you done now?
That's it.
Okay.
That's all she wrote. Yep.
Then we're leaving. Thanks for being there, though. We really appreciate you. And if you have questions for us, just go to talkingrealmoney.com and type them in or speak them in on the contact form. You can actually speak your questions in. And by the way, I need some people to speak them in.
You're running a little short on the speaking
I am
part.
running low on speaking questions now.
We have a lot of Q&A we could do. I could throw a few at you if you need to when you got to record that. So let me know.
All right.
Got a lot of printed type
Either that
questions.
or I'd make you and Roxy do one.
Yeah, please don't make me do anything more this week.
No, you got to do it. Do it right
now.
now.
Still tired from retirement.
Thanks for being there. Thanks for joining us almost every day on our little podcast as we are constantly talking real money.
The opinions and views expressed on this podcast were current on the date recorded.
Opinions, estimates, forecasts, and statements of financial market trends that are based on current market conditions constitute our judgment and are subject to change without notice, including any forward-looking estimates or statements which are based on certain expectations and assumptions. Although information and opinions given have been obtained from or based on sources believed to be reliable, no warranty or representation is made as to their correctness, completeness, or accuracy. Information presented on the podcast is not personalized investment advice from Appellate Wealth. The views and strategies described may not be suitable for everyone.
This podcast does not identify all the risks, direct or indirect, or other considerations which might be material to you when entering any financial transaction.
Past performance does not guarantee future results, and profitable results cannot be guaranteed. We hope you realize that the information provided on Talking Real Money is for informational, educational, and hopefully enjoyable purposes only. The podcast is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Appellate Wealth, a fee-only registered investment advisor.
Please see Appellate Wealth's ADV Part 2A on our website for information regarding Appellate's fees and services.
Appellate Capital, LLC, DBA Appellate Wealth, is an investment advisory firm registered with the Securities and Exchange Commission. The firm only transacts business in the states where it is properly registered or excluded or exempt from registration requirements. Registration with the SEC or any state securities authority does not imply a certain level of skill or training. Appellate does not provide tax or legal advice, and nothing either stated or implied here should be inferred as providing such advice. Thanks for listening, and please visit TalkingRealMoney.com for more information and important disclosure related to performance of any specific index or fund quoted in this podcast. And the lawyers get richer.